You've been with us probably since Monday. You were with us since Monday.
You were.
Had many contacts, discussions. What mood did you feel around, both from LPs, fund managers, and if there's any buzzword you've heard, let us know which one it can be. Jenny, perhaps on that first?
I'm happy to start. I mean, I guess it's not surprising, but I think most of the people that are attending IPEM in Paris are still pretty bullish on the outlook for private equity and the ability for private equity to continue to outperform, being the theme of the conference. So, you know, you don't find general kind of pessimism or we don't want to be in the asset class anymore, but that's not surprising given, you know, most of our jobs are dependent on that philosophy. I think what you do sense is that depending on the type of organization that different LPs are coming from, there are different kind of more top-down views within those organizations that influence how those organizations as a whole are thinking about private equity. And I think organizations that come from a more kind of total portfolio approach rather than a strategic asset allocation approach, so they're, you know, assessing each opportunity relative to all other opportunities in any sector at any time. I think those are the organizations that are seeing probably more pessimism and, you know, certainly this sense of the narrowing gap between credit and private equity returns, making it seem more interesting to shift perhaps into private credit. And I think Steve Schwartzman talked about that yesterday in terms of, you know, being able to get 13% returns on fairly secure credit instruments. It's kind of a no-brainer. I think the private equity opportunity set sort of, you know, needs to deliver meaningfully above that. And I don't think everyone's convinced that it can do that. Whereas I think if you're coming from more of a traditional strategic asset allocation approach, not seeing a change in views, the role that private equity plays is still quite important to those organizations, albeit a lot of organizations are over-allocated and are therefore scaling back. But I'd say generally still pretty bullish. I think at the LP session on Monday, Greg Brown presented some really interesting data around the embedded alpha within the private equity asset class, where he talked about over different discrete time periods historically, private equity market as a whole has delivered sort of 3 to 4% ahead of listed equity markets. And that's, you know, that's one of the things that we take to our investment committee very regularly to argue why we should be quite bullish on private equity. It is one of the few asset classes where you're fishing in a pond where there's embedded alpha. So depending on the vintage that you allocate, the embedded alpha of the asset class historically is anywhere between 0% and 10%. And there's not many sectors where you could do an average job and still have a greater than 50% chance of beating your benchmark. And so when we put it in that perspective with our investment committee, the case for allocation is very strong. Even when we think we may not be in the best vintages in the next few years, the case for alpha is still very strong. And then obviously, because we all believe we can be top quartile and we're not going to build medium portfolios, you know, then there's another 400 to 800 basis points that you can add to that. So even though we think the absolute returns may come down, we think the case for the relative returns is still very strong.
Michael?
Yeah, I mean, a lot of in agreement with that. Thankfully, we're listening to the same things. But, you know, no doubt it's been a tough environment for GPs. And listening to them over the last few days, you know, they're a little bit more downbeat than normal. But having spoken to a lot of LPs and speaking to our own LPs within Mercer, there's a lot of expectations for good future vintages ahead. And we spend a lot of time looking back at the data historically, limited and all as it is within private markets. You can still pick out some interesting pieces. The one that's probably of most interest is that fundraising does exhibit cyclicality. And what I mean by that is if you can find periods where rates are raising and maybe stabilizing, and if you can also find the same periods where fundraising environment is tougher, those vintages that follow in the year or two afterwards tend to be some of the best vintages to invest in for LPs. And LPs are aware of that because there's some common sense to that. If rates are rising, it probably means valuations are coming down, and that's why it's a tough fundraising environment. But it means then that future vintages are investing at at better valuation points. Investment managers have a 3 to 5 year investment period. They're investing into the knowing world that we're in at that point in time of higher rates, whether inflation stays sticky or not, and the themes and opportunities of the future they can build into that. And LPs are very aware of that. Definitely in the last 12 months, when we look at why has fundraising decreased, a lot of it has been from the pension scheme sector. Rates have gone up. It means their liabilities have come down. The required return they need on assets is now a lot less. So they didn't need to re-up over the last 12 months or so. But that'll change again next year and the year after. But for other institutional investors, what had held them back a little bit was the fact that distributions were a little bit slower over the last 12 months than they would have otherwise have been. So from a cash flow planning point of view, LPs have been holding back, waiting for those distributions to start coming through again, which will undoubtedly happen over the next 12 months or so. So our expectation is that we'll be kind of back at it again in a more meaningful way next year. And like, that's not to say it's looking at was it 1 trillion that was going to be raised this year? It's not like it's a small amount, so it's still pretty impressive.